And today's episode is brought to you by Diag Partners, staffing and recruiting that moves at the speed of your business. Check them out today, diagpartners.com. Welcome back to In the Harbor. I'm your host, Jason Johns, joined by my co-host, Sean Richland. How are you, Sean?
Hey, I'm doing great. Nice week ahead of us here. Excited to have our guest join us from a very impressive group out of Boston.
Absolutely. And today's guest is Paul Karger, founder of Twin Focus. And that's been 20 years now, right, Paul?
It has, Jason. Really excited to be here. But yeah, we're celebrating our 20th year this year. So it's been, the overnight success that took 20 years.
Of course.
Always.
So Twin Focus is a boutique multifamily office?
Yep. We're a family office advisor. We work with about 50 families. We oversee about $12 billion for those 50 families.
All right. That's fantastic.
It's a pretty good number, I'd say. 50 families.
It's not as simple as 50 clients, though. I mean, there's a lot of complexity that goes into those 50 families. So,
You know it. Yeah, you know it.
I'd like to kick it off, though. You got an engineering degree at Boston University. So let's talk about that and then how you found financial services.
Sure. Happy to talk about engineering. Attended BU. Actually, I was back giving a keynote a few weeks ago and learned that BU is today considered in the top 25 of engineering schools in America. So it's great to hear that my degree is worth something, but also a humble reminder that I probably couldn't get in there today. But yeah, studied mechanical and manufacturing engineering and, went through high school kind of, working on cars and always interested in fixing things. So I thought mechanical engineering was a good fit. Never had the intention, I think, of actually being an engineer, but, learned some great problem solving skills and honed my math skills, in college. So.
And that kind of piqued your interest in the financial services just after, or how did you end up kind of making that switch?
Yeah, I was always interested in financial services. I didn't know it totally as a high school student, but I was always interested in the stock market and investing. And then, I guess, as the saying goes, you kind of create your luck along the way. But I just met some interesting people as a college student and had the opportunity to intern for them and very quickly realized that I was definitely not going to be an engineer. And I wanted to work in financial services. So had a bunch of kind of varied experiences there, from institutional brokerage to investment banking, and kind of laid the groundwork for me graduating and going to work as a broker in the late 90s, the go-go days of the late 90s.
Oh, those were the go-go days. They don't exist anymore.
Oh, what are you talking about? We're hitting new highs.
That's right.
Well, that's true. It's with all the headlines, it's easy to forget about. So as I think about Twin Focus, you started it with your brother. So what's it been like, truly running a quote unquote family office, family office for the last 20 years?
My brother and I have always worked together since we were little kids. My father used to say when we were little kids, Paul will get the business and Wes will run it. And that's kind of what happens, on a more grand scale. But we're very complementary. We have a great complementary skill set, and we've worked together so long. We finish each other's sentences, and we joke that we know each other better than the other knows ourselves. But it's been good. It's been a great journey, and frankly, one of the best gifts in life to be able to share something like building a company with somebody you're so close with. Especially a twin brother. That's
amazing. It's you mentioned complementary skills, such an important piece to building a successful company. You can't really both be doing the same thing. So when you speak to that, how is it run on a day-to-day basis? Or are you kind of the visionary? Are you more of the, what's the word I'm looking for? Not visionary, but help me.
Yeah, I'm more of your kind of classic entrepreneur.
Yeah.
I'm a really good salesman, a good storyteller. And my brother is the one that kind of keeps the trains running on time. It's definitely, we're just so different in terms of what we like to do and how we operate. But for sure, he's more operationally focused much more detail oriented, does really, really well in, planned client situations. We're running through, mid-year, year-end reviews and so on. Whereas I tend to be the opposite of that. I'm much more bigger picture, as I mentioned, really kind of focus on the kind of new business side. But both of us are equally involved in making the big decisions for the firm.
Sure.
And there's nothing that I would say that one of us is doing in a vacuum. We're totally in the know of what the other one has going on. We both have, we have a third partner as well, who's been with us for 20 years, 6 months after we launched the business, who's our kind of the brains behind the organization, if you will. He's a tax attorney. And the three of us collectively run the business together. We're all super involved in all of the client relationships. For sure, there are certain times or meetings where one of us or another one of us can't go, and we can tag team on those types of things. Yeah, it's very communicative. And Twin Focus is, it takes a village to run these relationships. As Jason pointed out, it's not just, 50 individuals, it's 50 families. So there's a lot of moving parts with every single one of these families. And while it takes, strong leadership and our ability at the top to really understand what the client is thinking and where the puck is going on those relationships, it takes a village to execute and implement the solutions every day.
I would imagine. And I think about, how has the family office environment evolved when you think about the complexities of investments, tax structure? Maybe the dynamic between you and Wes allows you to kind of see into how families kind of interact.
100%. And the fact that, there's been a massive proliferation of wealth over the last 20 plus years, which has given the need for, firms like mine and all these other service providers that are in the ecosystem. And, the truth is that 20 or 30 years ago, if you made $50 or $100 million in an exit, you were among the wealthiest families in Boston, in my backyard, for example. Today, it's not the case. There's hundreds, according to the Wall Street Journal back in April, there's 75,000 families with over $100 million net worth in America, right? There's something like 400,000 families with over $30 million net worth. So there's a lot of need for families to figure out all of this complexity. The environment has evolved, service providers have evolved, product has evolved. Today, firms like mine make a lot of sense, where you have kind of one neck to choke, if you will, that can help you manage all of these complexities. You're getting all different types of varied and sometimes conflicting advice from various service providers, accountants, attorneys. We work with the top attorneys and accountants in the world, right? In the US that work with these clients that we work with. But keep in mind, those top attorneys and accountants have hundreds or thousands of clients. And so, it's helpful to have a voice or a team like ours in the mix that's able to help decipher and kind of, follow the ball, if you will, and, make sure things are properly implemented after an attorney or an accountant designs a specific strategy. With my team, it's the hard part is the boots on the ground. It's not conceptualizing a strategy, which are typically tried and true for these families. It's actually executing the strategy every day and ensuring you don't miss, a promissory note payment or a tax payment or, some little thing that could kind of stymie the entire strategy. So.
And thinking about that and bringing up tax payments, what have you seen lately from a kind of relocation standpoint for tax purposes, which has been a huge trend when you think about, the just devolution of wealth moving into these non-tax states?
It's topic du jour every day with my families. Over the last 5 years, we're based in Boston. We have clients all over the world, all over the country. Certainly, maybe a third or 40% at one time were in the Northeast. I would say over the last 5 years, half of my Massachusetts, New York clients have left or are planning to leave. And I'm worried about it for Massachusetts. I'm a diehard Bostonian. I think Boston, especially on a day like today, where you've got 70, 80 degree weather, I think it's the best city in America. It's the safest. We've got an incredible history. It's a beautiful city. It's very walkable. It's the highest IQ in the country. It's the healthiest in the country. I could go on and on and on. That said, clients are leaving, families are leaving. I'm on the front line of this. It doesn't mean they sell their home in the Berkshires or Nantucket, or even their pied a terre in the city. They sell it to the kids' trust and rent it back per diem. They still have their home in Nantucket, but they decide to live somewhere else, like New Hampshire, only 45 minutes away, 30 minutes from Boston, or, more popularly, Florida, South Florida. So I think it's a big problem for Massachusetts. I understand the rhetoric out of the, 90% of the population, because they feel like it doesn't impact them. And they say, it's okay, the rich can leave, or who's going to buy their homes or whatever. The truth is, my clients have mobility. They have the ability, they already own homes in Florida, right? And now they just need to check the boxes and follow the statute to make sure that they can become tax residents there. So it's a problem, I think, for Boston and for New York. And I'm on the front lines. Massachusetts implemented this millionaires tax a few years ago, where they're charging 9% on all income over $1 million. So it's 5%, which is a typical income tax in Mass, and then it's another 4%, so 9% on all that income over $1 million. Whether you have a capital gains, or it's just a big earning year for you. The real killer, I think, for Massachusetts is the 16% estate tax. There's a credit at the federal level, so it's not 100%, 16%, but it's significant. I was just meeting with a client this morning, got a couple $100 million balance sheet. We showed them that if you pass away here, second to die, pass away in Massachusetts, it's going to be another 25 million or so off of your estate that your kids are not going to see. Oh, and you already own a home in Miami. Like, why don't we make the move? Why don't we think about making the move in the coming months? So it is a big topic, and Massachusetts currently has some billions of dollars that are, they've collected over the last few years that are in their coffers from this mass millionaires tax. And, they think it's been a big tailwind. I can tell you it's going to be a headwind in the next few years. And the problem is, like, not only do those income leave, that those charitable dollars leave, eventually the companies leave too. The CEO starts, he brings a C-suite down there to Florida, and then all of a sudden the company's moving too. So Massachusetts actually has a problem from both ends. Number one, the wealthy people at the top are leaving. And number two, at the bottom level, it's because it is such a great state, it's become unaffordable.
Right.
And so young people, are having a tough time working at, companies or tech companies like HubSpot that was started in Boston, or PTC. It's expensive.
Well, and that's one of the real advantages in Boston. You have so many undergrad students based in and around the Boston metro area. I think it has more universities than any metro area in the U.S.
It does.
Yep.
Which probably adds credence to your high IQ argument.
It's true. It just use your friend ChatGPT or Claude and ask where the healthiest and where the highest IQ are in the country. It's Massachusetts and New Hampshire.
Oh, that's
so. And I say all the time, I judge a place by the average place you go in to eat, or you walk into the gas station. Gas stations in Massachusetts, and people are pretty smart. It's very different than a gas station in Florida.
When you think about the charitable giving, with all the folks moving in high tax states and going to the Floridas, the Texas, so on and so on, some to Puerto Rico, you think about what they're going to ultimately do with their charitable life. Dollars that they maybe were exposing to the markets that they live in Massachusetts, wherever. Now they're going to be in Florida, and they're going to want to donate to the hospitals there, make those hospitals better, or whatever it might be. So how does that play into all of this? And I know there's a lot of charitable organizations that are trying to reach out and grab capital.
The small charities are struggling with it. And as you mentioned, the hospitals, you think about, I'm in Boston, right? We have the High Church of Medicine here, right? MGH, and you've got Beth Israel, and, all these other wonderful institutions. But the truth is, you give to hospitals for access. That's the truth. I literally was just having this discussion with a client this morning who's moving to Florida, and they said they want to focus their giving on Florida, and they've been Massachusetts residents for decades. So charities are feeling it for sure.
Yeah, I think that's fascinating. It's always the unintended consequences of any government regulation. They do back of the napkin math on how much they're going to raise on any new tax or any new item, but they don't think, what's the next follow-on effect of that, and it kind of rolls downhill.
For sure.
If we get into, we were just talking charitable giving, so let's talk about your 20-year anniversary. I saw you were doing a 20 for 20.
20 for 20. We're giving back to 20 community-based organizations. Many organizations we've supported for decades. One, in fact, is a charter school that I founded about 15, 16 years ago, but everything from, great hospitals in the Boston area to arts, education, other really great nonprofits in town. And we're celebrating those nonprofits by interviewing many of the executive directors. We're also doing a lot of volunteering with the team in just various community-based, organizations and events that we can help out, get back.
So
it's been fun.
It's not only giving, but you're helping them get the word out that they do exist. And
yeah,
yep,
it's huge.
Yep.
That's amazing. Getting back to the tax relocation geography, the transition from public. People think if you're wealthy, it really simplifies life, and in fact, there's so many moving parts that you guys have to manage. And with the families that you have, you're not just involved in the capital part of it. You're involved in so many areas. What have you seen evolve the most over your 20 years there?
I think families' willingness to embrace the complexity, as you point out, as I remind my team and I remind my clients all the time, these are high-class problems we're dealing with. But most often you're ranking, your priorities around, complexity versus simplicity. But the truth is, if you want to preserve wealth for future generations, you want to do it in a tax-efficient manner, depending on how complex your balance sheet is, it's going to necessitate a complex and more sophisticated solution to be able to do that. Families have to be willing to embrace the complexity, and it's why there's a need for folks like me, folks like these complex estate planning attorneys that are doing a complex estate planning outside of your bread and butter revocable trust type work. Families that have been willing to embrace. I think the other interesting trend that I was discussing this morning with my team is 15 years ago, investors, high net worth families couldn't get enough of quote unquote alternative investments. Everybody needed private equity, venture, and some of that stuff has worked out really, really well the last decade. Certainly venture, we're reaping the benefits of this now with all this AI and tech and so on. But I think a newer trend is folks kind of shying away from that, because I think private equity has almost become like a dirty word. People think that there's so many fees and opacity involved in that. That folks are just shying away. I'm having clients with new wealth, worth hundreds of millions or billions, showing up and saying, what, I don't need a lot of that stuff on my balance sheet. So the sexiness of that stuff, the allure of that has kind of gone away.
Well, and part of that might be the democratization of the alternatives, because they're looking for all these asset managers looking for new sources of capital. So maybe it loses
go to
its
retail.
Yeah, it loses its sex appeal.
Go down to retail. See if they'll buy it up.
Are you seeing that in the credit side as well, or just the equity side?
Both. Obviously, the last 5 years, private credit has been a hot dot, and everybody's poured into that. We were not super big on private credit. We've been very selective in private credit. We've been talking about it, writing about it for 5 years. Now we look, really smart. But I remind my clients all the time that Wall Street's a place that looks to separate money from their investors, and always just following the hot dot, is a surefire way to do that. So you got to figure out a way to stay disciplined and not get sucked into loving investments that don't love you back. So.
We want to take a second to thank our sponsor, Diag Partners. We've worked with Diag directly here at Rock Harbor, so we know firsthand they deliver. If you're running a company and have a seat to fill, or you're a professional thinking about your next career pivot, these are the people you want in your corner. Placements from analysts to executives done with speed and discretion. Check them out today, diagpartners.com. Well, and I read an interview you gave where you were talking about diversification being the only free lunch out there. So I am interested in how you work around. I would imagine a lot of your first generation wealth creators have concentrated stock positions.
Yep.
So that would have to come into account as how you're kind of de-risking the portfolio from that aspect.
As I say to new clients all the time that have concentration in their life, as we all know, you typically make your money by concentrating and you keep your money by diversifying it. And, when clients show up with big concentrated positions, I'm not telling them anything that, I wouldn't say to myself, like, we need to figure out a way to diversify some of this. Just, bad things happen to good companies all the time. Look at what's happened to this whole, the SaaS sector, right? SaaS apocalypse. Like,
Right.
we're living here in Boston with a bunch of these high flying names, or what once were high flying names. Even more prescient is I work with a lot of newer CEOs today, CEOs of AI businesses, and I, as well as likely you and the rest of the world, believes that AI is changing the world, continues to change the world. But prices can get disconnected from reality, and if you have a chance to take meaningful money off the table, and at any point in your life, you've got to really think hard about it, especially if you've got nothing. And it's I think there's certainly stages of wealth or levels of wealth where life starts to change. Maybe 5 million is the first, maybe 10 to 20 is the next, maybe 50 to 100 is the next. But if you have the chance to pull some wealth off the table and the universe gives you that shot, you got to think about it and not necessarily stuff it back into the universe, in the same way. So thinking about asset allocation today, we're very barbelled in our allocations. You have to have this kind of, exposure to global growth. You have to have exposure to the AI trade and infrastructure and all of that. But, talking about the go-go days of the late 90s, like, we're in the go-go, just replace .com with AI. We're living it today. It's happening much faster. These companies are absolutely more profitable. You're seeing companies go from zero to $400-500 million of revenue inside of like 3, 4, 5 years, which is unheard of.
It's crazy.
But still, the world can reprice those businesses very quickly. And if you're getting a chance to take out, it's always hard when you have a company that goes public that you have to sell your, if you're an insider and it takes you years to sell down stock in a public company. It's just painful. If you get the chance to sell your business before it goes public, or you're able to take secondary off the table, like, it's something you should really be thinking about hard.
Right. And I wonder how much emotional connection there is to that stock too. Like, that's something you probably have to fight through.
A lot. Yeah, especially, while individuals are still involved with the business, either still running the business or still on the board, or it's their baby, right? Because they founded the business. But that changes too over time. Just like your feelings about your own kids change over time, about how much you're going to leave them, how much you're not going to leave them. It evolves. It's the same thing about, a company like that.
So I saw an interesting statistic the other day that kind of ties into what you were saying and the need for diversification. Do you know the last time we had 4 years of double-digit returns on the S&P 500?
No, I don't.
It was 95, 96, 97, or 96, 97, 98, 99.
Really? That's the last time. Well, like he mentioned, it's similar to the .com. I mean, just put .com in front of it. It's pretty similar. It's not the same, but it definitely rhymes. There's some similarities to it.
Well, we have first $1 trillion company was Apple in 2018, and now we're having what's looking like $2 trillion IPOs.
Wild.
Yes.
So you're right. We are in the go-go days of the the roaring 20s.
I know it's pretty intense, especially when you're managing families. What did you guys, Paul, get involved in the coins at all? Were you involved in Bitcoin or any of the things that
really at the margin? I mean, I own a little bit of it myself. We had a couple clients that were pretty emphatic about owning exposure, but other than that, it was like, for clients that were interested, which I'd maybe say was 20%, maybe it was like a 1% position
right.
We've tax traded around that. Gold coins, we've been big owners of gold for over 20 years. Since I was a broker at Payne Weber at UBS, I've owned gold in my portfolio is always like 3 to 5%. Today, it's more than that. It's we haven't really rebalanced for most clients. Some of them it's north of 10 to 15%. I think it's a great asset to own. It doesn't pay you a dividend, but I do think it's probably the only real safe currency, if you will, in the world. And I think central banks agree with me. I personally buy gold. I buy gold very regularly, 50, 100K at a time, gold coins. But you don't have to buy coins. If you have coins, you got to figure out where you're going to store it. But you can buy ETFs like GLD or IAU, which we own across our portfolios.
Right. It just makes it easy.
Sure.
And then same with Bitcoin when you saw IBIT come out, the fastest growing ETF.
Yeah.
I would be curious if we get back to your core business. I would imagine there's an educational component with the second and third generations. How do you manage around that?
Yeah, there's a lot of different types of education around second and third generation. Certainly one is just general wealth stewardship. Um, you know, it's got to be done in phases, and it's got to be done when kids are ready. A lot of times just kids are not ready. They're just not interested. Teenage years, early 20s, when they're coming out of school, getting jobs, they're just not interested. And what we tell families is we kind of build up to it over time. As the kids start to get a little bit older, we host annual summits, family summits, and either at their summer home, or we'll go someplace and meet the family. We'll do, a powwow and run through, maybe some trusts, educate them on the trusts, maybe educate them, maybe not on the overall numbers, but on overall family infrastructure, legal, tax and legal infrastructure, why these things are important. We'll start rudimentary estate planning with them, a durable power of attorney and a healthcare proxy, for a college age kid. You want to be trying to have these conversations before Johnny comes home and says, "Hey, I'm engaged." Oh, we got to talk about those three trusts, $60 million in the two trusts. We've got to discuss that. And so, then when they do come home and say, "Hey, I'm engaged," we start the prenup discussions, right? So I was real time having these discussions this morning with a couple of clients at mid-year reviews. I think the other area, which is interesting, is a lot of times families, let me preface it to say that we work typically with first generation wealth. And a lot of times first generation wealth families don't make it, and they don't make it at a young age, which I think changes the perception of, what kids have and what they don't have at earlier ages. They tend to make it, when they're 40s or 50s or 60s. And, I didn't have my kids until I was in my early 40s, so it's a little bit different. But, typically if you're in your 40s or 50s, your kids are older. Maybe they're in high school, or maybe they're going off to college in their 50s. And it impacts the way that everybody thinks about money, from mom and dad to the kids that didn't necessarily have, Bentleys and Ferraris growing up. And now mom and dad have a really nice place in Miami and maybe a nice summer home somewhere. And they take fancy vacations. We've seen families, turn over trust to kids that are in their 30s, 20s, 30s. And this was a live discussion today at lunch. The family was saying, even though our kids have some millions of dollars in their name in these trust vehicles, they don't feel like it's theirs, and can you help educate them on, there are funds here. Mom and dad actually want you to use these funds to enhance your life. Not so much that you do nothing, but they enhance your life, whether it's, pay for private schools for your kids, or buy a nicer house for yourself, or, maybe fly business class on a vacation rather than everybody back in the bus going to Florida or something. And so it's educating them on just overall financial literacy, wealth stewardship, but it's also about like, hey, mom and dad want you to realize that this money is really tangible, and it's here to help, enhance your life. So there's a lot of that educating.
With the younger generations, are you seeing increasing influences, around value aligned investing? It seems to me that is popping up quite a bit with Gen 2.
Yes, we are. Value line investing, and also value line giving. A lot of our families use philanthropy to help educate next gen around wealth issues, and, work to try to get everybody aligned. And sometimes family giving, discuss it around the holidays. Hey, maybe they give a budget to each one of the kids to give away. But sometimes we see that not go well as well. So if mom and dad are completely not aligned on, kids want to give to pro-Palestinian causes, and mom and dad are like, old school, Jewish family. They just like, it's a third rail for us. So, there's a lot to think through and reconcile. But I think it's a great thing to start early with kids, educate them early, give them test runs at things, and see how they do, whether it's investing money or, a charitable budget, if you will, whether it's $1,000 or $10,000 or $100,000 as kids get older. If wealth is going to be a big piece of you and your kid's life, you want to try to start early on educating them. So.
Great point. Yeah, and that's actually that's a great, practice and run through, is giving them small amounts to give, and almost mission driven capital where they're thinking about areas they want to support. I'd be curious, what destroys wealth faster, poor investments or poor family communication?
For poor investments, it's got to be really concentrated, and shit has to go really wrong quickly, right? But I think both can do that. I think private investments, early stage stuff, people fall in love with investments, that can destroy wealth. I think the other thing that just generally destroys wealth is not just family communication, but just lack of planning. Just by the numbers. If you don't properly plan, Uncle Sam's taken a big chunk of your wealth, at second to die. And then there's dilution. So, I told my oldest son that, his brother and sister have diluted him out of his own net worth, but, in truth, right, that's what happens over time. Is like, there's Uncle Sam's going to take basically 50% of all funds over, some millions of dollars, some, 20 or $30 million. And then if you're not properly planning, and then it's going to be split across, 3 kids, and then they're going to have kids. And I work with a handful, as is mentioned. Most of my clients I work with are first generation wealth, but I do work with a handful of families that are second, third generation, now in their 40s, 50s, 60s, and they've experienced this whole, the loss to taxes and the loss to siblings and marriages and failed marriages and so on.
Yes, the hated sibling, Uncle Sam.
Yes, he's tough, especially now.
Let's see. Where do you want to take it, Sean?
I really want to get into the martial arts. We kind of haven't really got into that yet, and I read a lot about your involvement, and just curious how you got into it, and how does that discipline help you with what you do on a daily basis?
Sure. Always obsessed with martial arts as a child. My brother and my sister were not. They thought I was crazy. But started at an early age with karate. In my college years, tried some other things, got involved with Thai boxing called Muay Thai. As my journey developed in my late 20s, started getting involved in other martial arts like Jeet and Kali and Western style boxing, a little bit of fencing. And then kind of my mid 30s got involved in Jiu-Jitsu. And it's certainly been a big piece of my life, just in terms of, teaching me that if you just keep showing up, things happen. Like, it's like, even when you don't want to show up, you just, it's just discipline over talent, and that works. And it's also been huge in terms of like the relationships I have, many relationships I have in my life all over the world. I've, friends and colleagues all over the world that have been involved in martial arts. Martial arts is a really great community. I say all the time that the jiu-jitsu mats are just very leveling. Doesn't matter who you are, what color your skin is, where you come from, everybody's there, kind of do the same thing. And it's like, it builds this really great camaraderie. But I've also had a journey in martial arts, not just as a practitioner. I was very involved and helped run Glory Kickboxing for the U.S. for the better part of a decade during the teens, 2012, 13 through the kind of pandemic. I was the chairman of the state athletic commission in Massachusetts under Governor Charlie Baker. So I got to see it really from a regulatory perspective. And I do a lot now. I invest in interesting martial arts leagues, and I sit on the board of a nonprofit here in the Boston area that teaches inner city kids martial arts, mixed martial arts. And I'm actually in the process of opening a jiu-jitsu school in the suburbs with a close friend of mine who's going to really run the day-to-day, but in Wellesley, Massachusetts. So
well, that's really
exciting.
cool.
That is cool. And you've practiced a lot of different disciplines within martial arts. So it sounds like with opening a jiu-jitsu studio, that would be your favorite, but is there a favorite? I know like Jeet Kune, isn't that an amalgamation of several?
Yeah, there you go, Bruce Lee right there.
Oh, that's so cool.
Yeah, Jeet Kune is 27 different martial arts combined. And Bruce Lee's philosophy was really about, everybody having their own Jeet Kune. What works for me is going to be very different than what works for you, depending on age, size, skill, speed, tenacity, and so on. But yeah, I mean, a favorite, I'm like most that get into jiu-jitsu or get pretty addicted to it. But I was the same, I think, with Muay Thai. Jiu-jitsu is a little better for me as I've gotten older. The striking is just hard on the hands and the feet and the legs. And jiu-jitsu can, not necessarily always, but can move at a slower pace. Yeah, I mean, for me, I think honestly, it's just about being active, staying active, staying strong, staying, kind of fight ready. I rolled this morning at 4:30, 4:45 this morning. And I teach my kids class on Mondays and Fridays, which is like the highlight of my week. My two little boys and my daughter. My daughter trains as well. She's 5.
That's great. That's a really good idea.
Awesome to pass on too. Something that you were passionate about as a child that now your kids can be passionate about.
Yeah, I think like a lot of things, like kids are passionate about what their parents are passionate about. Oftentimes, the best basketball players, their father was a basketball player. The artist, mother was an artist or something. And I think kids see that at home. My kids share my passion also for martial arts. They give each other a hard time if one of them says they don't want to go that day. My oldest son would be like, "You're gonna quit jiu-jitsu. You can get beat up. Lennon, let's get with the program. You don't want to get beat up at school."
It is a great way of self-defense. You brought up a good point there. I was having a conversation with a guy about trying to get kids to read more instead of watching videos or whatever. And he's like, "Well, are you reading a lot at home?" And I was like, "Well, of course I am." He's like, "Well, your kids see you doing it?" I was like, "Probably not." He's like, "Maybe you should have them around to watch because that's typically what they're going to do. They're going to do what you do." And you bring up a great point to bring them to the Jiu-Jitsu studio. That's good stuff. You're a good dad.
Yeah, I think the reading thing is tougher. Education, and this is probably beyond the scope of this discussion, but education needs a complete overhaul.
Oh, for sure.
And we have the power to do it. We've got the technology to do it. But it takes some radical thinking, and it's going to take parents embracing, it's a bit more radical than, a teacher standing in front of a class of 20 or 25 kids trying to teach all 25 kids as if they're the same level, which we all know they're not. And the truth is, like, if kids don't get, like, actually if humans don't receive some type of immediate gratification, we can preach and say, oh, you need to be patient and you don't need immediate gratification. But the truth is, people want immediate gratification. It's why kids like going to an arcade or like playing a video game, because there's immediate gratification. So if you can figure out how to solve that, and there are some solutions out there, I'm exploring some for my kids. And with AI, if like my oldest son doesn't really like reading, but if he's super into music, and if you give him a story about John Lennon or Paul McCartney or Mick Jagger, he won't put it down, right?
Mm-hmm.
So, but using AI, you can customize, and you can give some kids something that they're very interested in learning from.
To your point on immediate gratification, we have it here in our office every morning. The team plays the puzzle game on, is it on LinkedIn or was it on?
No, it's just a website.
It's just a website. Yeah. So it's like, boom, you win or lose. So if everyone wants to do it,
Or all the LinkedIn games for that matter. Everyone needs immediate gratification.
Yeah, no, that's so true. I agree with you though on the educational overhaul as a society. It's something's got to give here. It seems a little broken. So
we spend $1 trillion a year. We spend $1 trillion a year in education in America, and you still got big percentages of kids in high school can't read, right? And for sure we have seen a peak in higher education. Like there's no chance that 10 years from now people are going to be spending $400 plus $500,000, $600,000, $700,000, $800,000 for a college education where you come out and knowledge is ubiquitous, right? It's flat. So the world's, there's going to be some big disruption, I think, in the education space.
What I'm seeing anecdotally, because to your point, AI should be a huge advantage for any students right now. And I feel like students have been scared to death about using it because they think about using it and then it's just copying word for word. But as a study guide, like you can create your own tests, you can go deep on any subject you want. They should be using it more. And another message from our sponsor who makes the podcast come alive in the harbor, Diag Partners. Hiring the wrong person is expensive. Diag Partners exists to make sure that doesn't happen. They're fast, they're selective, and they get it right. Whether you're hiring or looking, don't leave it to chance. Visit www.diagpartners.com.
Yeah.
If the teachers are allowing them to use it, right?
Yeah, it's really it's a complicated one. A lot of kids use these chat bots. The truth is kids are on screens too much every day. I think the average student in America is on screens like 6 to 7 hours a day. That's too much. I'm standing in front of 3 big screens right now, and I'm on screens probably 10 hours a day. But it's different, I think, for kids. There's this. I don't know if you're familiar with this new school called Alpha. It's actually been around since 2014, but it's a fascinating learning model where the kids are actually only on screens 2 hours a day. And it's concentrated learning. The kids don't do homework. There's no, there's no real attendance policy, but they're on screen 2 hours a day, and the AI is not, it's not actually like answering questions for them. It's actually like customizing all of the learning to their level, bringing the learning down to their level.
Well,
And
likely
that's,
their style too.
Exactly.
Because
Exactly.
everyone learns differently. So
Yep.
almost tailored to each individual student.
Yep.
Oh,
Fascinating stuff. And there's big investment implications for that. In fact, I was with a client this morning and they were talking about a lot of their charitable giving is on the educational front. And, how does new technology coming in impact education? I'd say it's huge. I was I started a charter school about 16 years ago in Boston. And it's focused on really the most vulnerable kids in Massachusetts, in the city, I should say. And, I was with the executive director of the school a few weeks ago, and we were talking about how, things need to change. He wants to explore how things can change and how we can make things change with the use of technology. There's no secret, like apps have been out there for 15 years. The Khan Academy apps, all this stuff has been out there. Education as an investment has actually been a pretty shitty investment the last 10, 15 years. So a lot of people have a bad taste in their mouth for investing in ed tech. But things are changing, and with AI, it's just a game changer. So,
yeah, it'll be fun to watch. I mean, kids today have the greatest advantage they've ever had, I think, in my mind, from both a learning standpoint and
my oldest son is 8 years old. He's infatuated with rock and roll, and he's always like, "Daddy, I wish I was like you, a kid in the '80s." I'm like, why? Then you'd be old like me. And the truth is, like in 2026, like this is the best time ever to be alive. With technology, the convenience. Sure, there are unintended consequences you need to think through, but from a healthcare perspective and what's happening, here going forward, I know there's a massive rhetoric across the U.S. that people just don't like AI, and you've seen it. All of these commencement speeches, everybody booing when people talk about AI. That's like taxi cab drivers booing over Uber, right? It's here. It's here. You got to figure out how you're going to use it. And I'm sure all those kids that are booing, I'm sure they're using it, right? I'm sure that absolutely they're using it. And I tend to agree with Jeff Bezos on this, that I think actually AI is going to create opportunities for a lot more jobs. Is it going to replace some remedial functions? Yeah. By the way, I have a tough time staffing for those remedial functions anyway. And now if we can replace those with, effectively robots, and have people thinking at a higher level, I don't think human interaction is going away. I don't think my job's going away. I think AI is going to make my business better, and be able to provide more clean information quicker, better, faster to clients. But at the end of the day, clients hire me for discretion, trust, judgment, decision making. That's not going away. And that takes years to learn. You can query chatbots, or you can query whatever, Claude or ChatGPT, this question or that question. It negates a lot of the human. Same thing with being a doctor. Doctors today are hugely aided by AI. And using a lot of these AI tools to help them diagnose and so on. But you don't want to hear you've got cancer from AI, right? You want bedside manner from a doctor that's going to help chart your course and be your partner throughout the journey, and hopefully to getting better. So humans aren't going away. It's just, people better learn how to use AI. We're using it every day at Twin Focus. I don't think we're replacing some certain functions, and we're hiring people that can think through using AI and know how to use AI. But I think it's only going to make us better. So
I would agree. I think that's how everyone should be looking at AI. It should be a huge game changer. And I saw a stat not too long ago of how many people employed today were in jobs that didn't exist before 2000, and it was an alarming percentage. I'll have to see if I can find that number. So this isn't a new story by any stretch of the imagination.
Agree.
Is there a favorite version for you that you utilize inside of your daily work life?
I bounce back and forth between Gemini, Claude, and ChatGPT, depending on what I'm doing. I use Claude a lot to build models and run through various scenarios. But I'm only scratching the surface and what I use it for. We're not using at Twin Focus. We're not using agentic AI yet. We have a job rec out right now. We're hiring an AI automation engineer internally. Never thought about that in the past. Always thought about buying stuff off the shelf. That changed in February. We're You can actually build custom tools pretty quickly, but you need somebody that can manage all that internally, because everyone else here is just way too busy to pick up their head and think about building agents or something. But it's I think more and more you're going to have companies hiring folks like that can build custom tools.
I think so too. I think it's wildly popular.
I would agree. So if you think about the last 20 years and the immense success you've had at Twin Focus, what are you most excited for the next 20?
I'm excited that we're black belts now. Like we've done all the learning. And by the way, being a black belt doesn't mean you know everything. It just means you've seen a lot, and you know how to deal with different situations and scenarios. That's what I think I'm most excited about, is like we've kind of figured it out. There's always new challenges that get thrown at us. But after working with families for almost 30 years and at Twin Focus for 20, we've kind of seen it all. And that's why people come here. We've had tremendous growth in our business the last few years, and a lot of the growth has come from people finding us on these Chat GPT or Gemini or something. And I think what's happening is Gemini or Chat GPT is throwing up a list of candidates that they could consider, and a lot of these firms are much bigger. There's been a big trend in our business of selling out to roll-ups and private equity, and we haven't considered any of that. My brother and I are, we just turned 49, so it's not like we're 59 or 69 trying to think through succession. We've got a really great bench of, young leaders here that are late 30s, early 40s that are kind of the leaders of tomorrow. So we haven't thought about that. But, when people are entering their information into ChatGPT and it says, hey, you should talk to these 5 firms, and they say one firm that's got, 15 offices all over the country, it's backed by private equity, and it's managing 250 billion, versus Twin Focus, it's got 12 billion, and you can work directly with the partners. There's something to be said for that. And I think that's why we're winning a lot of these mandates. And I think the other big thing for us is, because we have been doing it so long, and we do have the black belts, we can say things with authority. Also, me personally, I've done really well, personal success, and I'm thinking through many of the same issues that my clients are thinking through. I've got little kids and setting up trusts and insurance and foundations and charitable giving and all this stuff. So it's, I can say to a client, well, this is actually what I'm doing. This is what I'm investing in. This is how I think about the world. And I think that holds a lot of weight over just, a banker or a broker at a firm, or, somebody that can talk to you on that level, and it's you really feel like somebody you're sitting across the table from you understands your situation. So I think it goes a long way.
I would agree. And I think you're in a unique seat. The old adage, good decisions come from wisdom, and most of that comes from bad decisions. And you can learn both from your clients' bad decisions as well as your own throughout life. So
we try to pontificate that all day long with clients. We tell them, listen, we've seen something go wrong. I actually have a client that says, the reason I don't have my own single family office, and he could very well have his own single family office, is because he says I have FOMO. And he's like, you guys get to see what's going on with all these other clients and all these other families. But really Jason, I say that all the time, that success is just a series of failures. It's jiu-jitsu too. Like, oh, won't do that again. So that's how we learn.
Right. I mean, that's a great point on the multifamily office too.
Yeah, I never really thought about that, but that makes a ton of sense what you just said there, FOMO. And it's not like a negative way of FOMO. It's realistic.
Yeah, it's FOMO, and it's also, with all due respect to many of my clients, like I can attract, hire, retain talent better than they can. Running a single family office is just, it's different. Like if your principal rolls out of the wrong side of the bed in the morning and they don't want to make investments in real estate, or they don't want to do this or do that, it's you're kind of stuck, and the other thing I would say is, single family office versus, my situation is like with my clients, I just tell them the raw truth. No BS. Tell them like it is. I'm not afraid of getting fired. Say, listen, this is what you hired me for. I don't have to be your yes man. I'm telling you, it's not a great decision. If you really want to do it, I'm going to try to protect you as much as possible. This is where it can go wrong. Whereas you're just reticent to do that if it's like your boss, right? When you're trying to keep your job, and you say yes more than you say no.
Yeah, I think I haven't thought about it that way.
Makes sense.
It was probably going to be in our rapid fire segment, Sean. So we're
let's get to it.
All right, so we like to end these episodes with rapid fire questions, so you can say kind of whatever comes to mind first.
Quick answers, though. You don't need to go too deep on any of these. So go ahead, Jay.
Well, I thought the best one, we kind of already covered it, but I'll give you a layup. Biggest misconception people have about multifamily offices?
That we're purely focused on investing.
Most underrated quality in a great advisor.
Ability to become your client's best friend very quickly.
Mm-hmm. I think I know the answer to this one, but I'm going to ask you anyways. One city you never get tired of visiting. I have a feeling you're there.
Yeah, Boston.
He likes, so the Bruins, the Celts, Pats.
Red Sox, yeah.
It's a pretty good town. And you're a Terrier, too, so you get some good hockey there, too.
Yeah.
One book everyone should read.
The Bible.
Today, when you wake up, what does winning mean?
Winning means getting to hang out with the people I want to hang out with, spending time with the people I want to spend time with.
That's a great answer.
That's a great answer.
Best lesson martial arts teaches you about business?
Everything takes time.
And I think is this the last one we got, or did you come up with any more?
No, that's the last one.
Harder opponent, markets or ego?
Say it again.
Harder opponent, markets or ego?
Ego. 100% ego.
All right, we got it.
All right. Well, really appreciate your time, Paul. This was fun learning about kind of your day-to-day and what you do, how you think about business. I did sense there was a bit of a parallel between how you address your clients and the amalgamation of martial arts that is, what is it, Jeet Kune?
Yep.
There's a practicality to it, right?
Absolutely.
Like use what works.
Use what works. Don't box the boxer. Be ready for multiple scenarios. You just don't know what's going to happen. And live fight ready. Right?
Awesome. Well, thanks for your time. It was wonderful to spend time with you here today, and congrats on all the success at Twin Focus.
Thanks, guys. Appreciate it.
Thank you.